All right, let's just jump right in. Welcome to This Explainer. Today, we're pulling back the curtain on the actual high-stakes trading floor. If you've ever wondered how financial advisors and investment analysts value fixed income securities in real time, without getting bogged down in those endless textbook math equations, you are absolutely in the right place. We're going to look at the exact playbook the pros use every single day. So, here's our roadmap for today. We're going to quickly navigate the fixed income landscape, tackle calculating bond value, reveal those real-time calculation secrets, navigate the big interest rate theories, and wrap up with actual market trading mechanics. Let's do this. Section 1. The fixed income landscape. Okay, so right off the bat, there's a stark contrast between the core instruments you'll see in the wild. On one side, we've got short-term treasury bills. Take a 90-day UST bill, right? It doesn't pay any interim interest at all. Instead, it trades at a discount. You buy it for, say, $99 and it matures at $100. That $1 profit, that's your yield. Now flip over to the other side, traditional bonds, like a 10-year corporate bond. These are longer term and pay regular, periodic coupon amounts, usually twice a year. It is a completely different cash flow structure. And man, how we actually track who owns these assets has totally evolved. Think back to the old movies. We started out with physical bearer bonds, literally physical paper certificates with actual detachable paper coupons you had to physically walk into a bank. Super risky, right? Because if you lost the paper, well, poof, you lost your money. Eventually, we wised up and moved to registered bonds with the owner's actual name on the certificate, which obviously solved the whole theft issue. Fast forward to today, it's all highly secure, instantaneous, electronic book-based formats, no paper, just pure digital efficiency that lets modern trading floors operate at absolute lightning speed. Moving right along, Section 2, Calculating Bond Value. All right, brace yourselves. The classic textbook method for calculating present value involves a frankly terrifying algebraic equation. To find a bond's exact fair price manually, you have to project out its future coupon payments, add in its final principal, and then heavily discount all those cash flows back to today's dollars based on the prevailing interest rate. Honestly, if you're sitting on a frantic trading desk with millions of dollars on the line, doing this by hand is basically impossible. Which brings up a really great question. How exactly do investment analysts and advisors crunch these massive, complicated equations in practical, real time? Because I guarantee you, they aren't mapping this out on a whiteboard while a client is holding on line 1. Let's find out in Section 3, Real-Time Calculation Secrets. Here's the pro secret. In practice, financial professionals bypass the manual math completely and use a simple 5-button sequence on a standard financial calculator to instantly map those complex cash flows. They just punch in N for the remaining compounding periods, I/Y for the discount rate, PMT for the periodic coupon payment, and FV for the face value. Then, just hit Compute Present Value. Boom! Within literally seconds, they have the precise, fair price of the bond. It completely transforms a complex calculus nightmare into quick, 5-second data entry. But doing this fast math often surfaces a highly counterintuitive question, one that seriously stumps novice investors. Let's say you crunch the numbers and buy a bond for $103, knowing full well it matures at exactly $100. Why on earth would you ever willingly guarantee yourself a $3 capital loss? Just throwing money away, right? Actually, scratch that. It's not throwing money away at all. The answer is all about yield to maturity, or YTM. See, you aren't just buying that maturity price of $100. You are buying a steady stream of coupons over the entire life of the bond. And the real magic? The magic happens when you take those regular coupon payments and aggressively reinvest them back into the market. That reinvestment snowball easily offsets that $3 upfront capital loss, ultimately giving you a solid, positive overall return. However, and this is a big however, this strategy introduces something called reinvestment risk. Think about it like this. If broader market interest rates unexpectedly drop after you buy that bond, you're going to be forced to reinvest those valuable coupon payments at a much lower market rate than you initially planned for. Because of that, your overall yield to maturity could actually end up being lower than the fantastic rate you were quoted when you first bought the bond. It's a hidden trap. Which naturally leads us to Section 4, Navigating Interest Rate Theories. Okay, if you only remember one single thing from this whole explainer, let it be this fundamental relationship. Picture a seesaw. There is an absolute, unavoidable inverse relationship between bond prices and interest rates. If market interest rates go up, newly issued bonds start paying more. So the yield on your older existing bond has to rise just to keep pace. And the only mathematical way for that to happen is for the actual physical trading price of your bond to fall proportionally. It's gravity. Prices up, yields down. Yields up, prices down. They always move in opposite directions. Now, when we plot these yields out over varying maturities from a quick 1-month bill all the way out to a 30-year bond, we generally get a normal upward-sloping yield curve. Short-term rates sit lower, long-term rates sit higher. Pretty standard. But what are the underlying macroeconomic theories that actually shape this curve? Well, there are 3 main ones we need to talk about. First up is the expectations theory. This one is pretty straightforward. It suggests that current long-term rates are simply a foreshadowing of what the broader market collectively believes future short-term interest rates are going to do. So if you see an upward-sloping curve, it basically means the market consensus is expecting interest rates to rise in the future. They're pricing in their expectations. Meanwhile, the liquidity preference theory takes a slightly different angle and looks at human behavior. It argues that, hey, investors naturally prefer the safety and immediate liquidity of holding cash or short-term bonds. So, to convince an investor to lock their money away for 10 or 20 years, they demand a higher return premium. That extra compensation for taking on long-term risk naturally causes the yield curve to slope upwards over time. Makes sense, right? Finally, we have the market segmentation theory, which basically slices the market into completely isolated buckets. It states that massive players dictate rates in their own preferred term sectors through pure, isolated supply and demand. For example, commercial banks mostly hang out and trade in short-term bonds, while life insurance companies who have to plan for liabilities decades into the future, they strongly prefer long-term horizons. According to this theory, the yield curve is really just a snapshot of the fragmented supply and demand driven by these massive institutional whales. All right, on to our final stop, Section 5, Market Trading and Mechanics. The market ecosystem itself is split into 2 very distinct halves. On one side, you've got the sell side. These are the investment bankers, the sales desks, and the traders who create, price, and trade products for their own firm's proprietary accounts. On the flip side is the buy side. These are your portfolio managers, your mutual funds, and pension funds who are actively buying and holding these securities on behalf of massive institutional clients and everyday retail investors. Now, when the buy side and sell side actually agree on a transaction, an electronic trade ticket is generated. And listen, this isn't just a simple receipt. It contains crucial, legally binding details. It lists the unique alphanumeric CUSIP identifier for the exact bond, the settlement date, and, this is super important, exactly how much accrued interest the buyer owes the seller. See, because bonds usually pay coupons every 6 months, if you buy a bond exactly halfway through that cycle, you literally have to compensate the seller out of your own pocket for the interest they earned while they were holding it. It keeps everything fair. But here's a thought. What if a massive institution wants to dump, say, $50 million in bonds without completely crushing the market price? To keep those massive movements quiet, institutions often use interdealer brokers. These guys act as wholesale agents who execute large block trades completely anonymously. They match up the big institutional buyers and sellers in the shadows, which helps with price discovery and prevents the broader market from seeing the massive order flow and betting against their position. And that brings us to the end of our explainer. So, with the yield curve constantly in motion and the math dictating precise pricing by the absolute second, it leaves us with one really provocative question to think about. As global interest rates inevitably shift tomorrow, how will these hidden reinvestment risks and shifting macroeconomic forces reshape the value of your own fixed income portfolio? Seriously, think about that the next time you glance at your monthly statements. Thank you so much for joining me, and keep learning.